Let's
Okay.
pray for a positive outcome between this emerging conflict between Russia and NATO and the United States. Obviously, probably the bigger conflict is the emerging conflict between China and the United States. Maybe it's a sad commentary, but typically, or at least historically, wars have been stimulative to the economy, but we should never pray for war.
Let's say somebody knows nothing about the case. He's watching Trevor Milton's testimony on Tucker Carlson, and then he's listening to you. How do they make a judgment for themselves, right? What should they be looking at? We're very pleased to be joined once more by Father Emmanuel Lemelson, CIO of Lemelson Capital Management and Orthodox priest. He was on the show just a month ago, and he's made a number of correct calls, including stocks that have gone up tremendously since his last appearance, as well as the interview before then when he first made these calls. We'll be following up on some of these calls, as well as his new picks for us and his macro outlook. Welcome back to the show, Father. Pleasure to have you today. Thank you for joining us.
Thank you so much, David. It was really a pleasure to join you as always. I just love your show. I think it's the best show out there on capital markets and the financial world. So thanks again for the invitation.
That's quite a statement coming from you, especially since you have a podcast as well. So thank you very much for that endorsement. Let me just flip over to this chart. This is Kohl's. Now, you were on the show last July 10th, and since then, the stock has run up from 959 all the way up to, I don't know what happened here, but I'll let you explain that. It went up 100%, then it came back down, but it's still up more than 50% since a month ago. And you've been calling for this stock to go up ever since basically early in the year. Since basically April, it's up 100%. Anyway, what is the story on Kohl's? We'll talk about this stock first, and then we'll move on to some other stocks. Why has it done so well this year, and why has it done so well since July, since you were on last?
Yeah. Well, David, I wish I could tell you I had a crystal ball and I just saw it coming, but I don't, and I didn't. All I can tell you is that, when you take a value-oriented approach, what you're really looking for is a margin of safety. So where, as I always say, speculators saying to themselves, I can pay $1 today for something that's worth 75 cents. The value investor says the inverse of that. They say, I can't pay $1 for something worth $1. I got to pay 50 cents in case I'm wrong or some bad news comes out. So this inversion of thinking between the speculator and the investor almost always works out, and it works out well over time. And in this case, our commentary on your show, I want to say it was April 7th? And again, on July 10th, we just looked at the tangible book value. Could not be a more boring company. It's definitely not the next NVIDIA, to be sure. But the price was so low, the risk was de minimis, in my opinion, and it worked out well. And at one point, I think it went up over 200% after our last show. So it did really, really well. And I think that was over 74 days or something like that it went up, from our April show till it spiked around at one point $20 or $21 a share from, I think it was $8 at the time. So it worked out really well. It's still up, like you said, at roughly 100% or something like that. We just published a Substack article on it. You can check it out. It talks about some of those numbers on our Substack. But it worked out really well. It's just your sort of archetypical Ben Graham style, buying the balance sheet at a discount while everyone else is buying headlines on CNBC, and that margin of safety again proved prescient.
Department stores like Kohl's, JCPenney's had a lot of trouble, but basically big box retail stores all across the United States have faced a lot of pressure in recent years from not just the emergence of online shopping, but from a host of other macro forces as well, especially since people have been spending less money now. So I wonder why this particular stock has been doing tremendously well despite these headwinds pushing against this particular sector. I mean, I know valuations is one side of the story, but are they doing something like business-wise that sets them apart?
Well, in all fairness, of course, you had this dive in the S&P 500, the major indexes, when Trump announced his tariffs, and that created great unknowns for the market. The market doesn't like what it doesn't understand. That creates fear, and speculators can be very skittish. And you might say, well, most of the market activity in terms of trading volume is algorithmic driven, but the people who write those algorithms are themselves speculators. So you can't really escape the personality driving this huge volume in the market. And it's understandable to a certain extent. Nobody really knew what was going to happen with the tariffs. We actually put out a podcast episode at the time, one of our more successful episodes, talking about the fact that was just very strategic on Trump's part. We don't think he's a madman when it comes to economics and the business world in America. But people didn't know what it was going to cost. A lot of that stuff, and coal stores coming out of Asia, obviously, although a lot of it really is coming from Vietnam and Laos and sort of these emerging economies in Asia in terms of clothing and whatnot. But it was just created a big unknown. And so here you had a price on a stock that you could say if they closed the doors tomorrow and they sold it and liquidated everything, like, would the common shares be covered? Like, if you could ask yourself that question, like, if everything went wrong and the tariffs went nuts and the economy shut down like March 2020 style, could this be sold to a private equity group or a private buyer even, for more than what the common share price is today? And would the common be covered, or is there something ahead of the common? And if you can answer that question affirmatively, then you've almost de-risked your decision. So your hedge in that case is that I could be wrong, but it would only take slightly good news, like Vietnam to come to a trade deal and so forth, or Bangladesh, whatever, to come to a trade deal with the United States and some of these emerging economies, and for the fear over the tariffs to pass, then people would reset that price, realizing that it's not the end of the world. And in this case, I think the S&P 500 went up 27% during that time. So we dramatically outperformed on that commitment in goals.
And I think if you just zoom out for a bit, if you take this chart, at what point do you say to yourself, it's time to take profits? What was undervalued is no longer, and especially, again, 100% run up in the last couple of months was great, but if you zoom out, it's not had a good run since basically a couple of years ago. It's just been a losing stock. Yeah, so at what point do you say to yourself, okay, it's caught up to its fair value, or do you think it's still really undervalued compared to where it was historically speaking?
Well, I think we called it, we probably referenced it as a sort of cigar butt investment, like we talked about Big Five at the time. A cigar butt's not a great long-term investment. In fact, it would be better to just buy great companies and hold them indefinitely than to do this.
Yeah.
Even what Ben Graham sort of talked about, this idea of price value dislocation, is not the best way to accumulate wealth over time, because what you want to do is compound your return. So a cigar butt by definition is short-term. In this case, when it shot up that much, that's when we sold almost our entire position. I think we have like 1 share or 10 shares or something, some stub position. But if it shoots up that much in a day and you've got this huge return, it's not going to suddenly become a great company next year or in 5 years. So it's, again, not the best form of investing either, this deep value balance sheet based allocation model. But it works, especially in a market where the market generally is quite expensive. Like we just hit a new high in the major indexes, I think yesterday. So there's not that many opportunities out there. I mean, there's no real like Nvidia's around as it was 3 or 4 years ago, the price opportunities, or what Apple was 10 or 15 years ago. I don't see that many opportunities. So you kind of go back to cigar butt investing. So if you've got this huge return, the stock was completely beat up, and you make this, I don't even know what that comes out to, annualized 200% in 76 days is some enormous number annualized. You could just take your profits at that point, I think, and move on, because again, it's not going to ever be a great company.
Before we continue, let me tell you about protecting your most important asset, your personal information. Now, your personal information is likely out there on dozens of data broker sites you've never even heard of. These sites collect and sell your name, address, phone number, and more without your permission. That's why I use today's sponsor, Delete Me. It's a service that finds your personal data across the internet and gets it removed. And it doesn't just do it once, it does it continuously and monitors it and removes it throughout the year. All you have to do is submit your information, and within a week, you get a privacy report showing where your data was found and what's been removed. The whole process is simple, and it runs in the background so you don't have to think about it. Go to joindeleteme.com/DavidLin and use the promo code DavidLin at checkout, or scan the QR code here on screen to get 20% off on all U.S. plans. Join Delete Me now and take control of your privacy today. Okay, let's move on to another stock that you talked about, Cetene. I believe you talked about liking Cetene last time you were on the show. It's had a huge dump, though. Are you still long the stock?
Yeah, we are. It's the second largest position in our portfolio. Our largest position is in United Health. I had intended to talk about United Health in our last episode when I joined you, but didn't get around to it. I was going to talk about it today. Today, I think Centene's up 4 or 5% last time I checked. I think it's down about 13 or 14%, though, since we last spoke on July 10th. But that doesn't bother me. At the time, I said, let's see where it's at in a quarter or in a year. So we have anywhere from 2 to 11 months left to see how it performs. I have no doubt we'll be proven right on it. I'd be surprised if we were wrong. A very boring company, really adversely affected by the Trump administration's changes to Medicaid and Medicare. And when they withdrew their guidance, it created a lot of fear, but still not that difficult to figure out the math in terms of what their EPS is going to do. And then just yesterday evening, Buffett announced, I think he bought 5 million shares at $1.5 billion stake in United Health, which is in the same industry sector. And then, of course, it's raising names in that sector because people realize this is a very unloved sector, very unpopular, and things are going to be just fine. They may not have the same lofty EPS goals that they had only a couple months ago, but again, it's so incredibly discounted. And in the case of United Health, you've also got a dividend. Now, United Health has encountered some extraordinary rough patches, so to speak, with the assassination of their former CEO. It gave rise to a lot of ethical questions and moral questions. What happened with Luigi Mangione, of course, who shot him in the back, a terrible tragedy for the CEO and his family. But when these sort of things go terribly wrong and a company becomes culturally toxic, it becomes radioactive. But if the underlying economics of the company are good, and these companies are also facing regulatory scrutiny, people get scared by that, especially retail. But a lot of the times, these regulatory matters pan out with a payment or some sort of resolution. The company actually improves its operations if they've done something wrong. And if the company's really moving in the right direction under new leadership, it's okay for investors then to allocate capital to that model. And again, very, very cheap. So I think United Health and Cetene are still great investments. That's not investment advice. Do your own research, as I always say. But for me, at least, I would say I'd be very surprised if it doesn't outperform the market in the upcoming quarters. Certainly within a year's
What's
time,
the
I'd be surprised.
overall macro thesis on healthcare stocks right now?
Well, it's a business model in the United States, again, adversely affected by changes in the Trump administration's policies, but there's not a lot of alternatives either for for Americans. So these large health insurers, they provide a service which is ubiquitous. So they're not going to go away. Their earnings may be adversely affected, but if the earnings, for example, just using rough numbers here, let's say it goes down 30%, but the company now is trading at a P/E of let's say 4 or 5 or something, and there's no going concern risk. They have enough of a defensible moat, and people are locked in. And in Centene's case, they can just raise their prices, which they're going to do. They're going to reprice in their different markets. And if you listen to what the leadership is saying within the company, it's very clear that they'll be able to address their earnings power, and their margins will be defensible, I believe, going forward. So what you're left with is a company that has a remarkably long track record of consistent earnings, which is what you really want, consistent earnings, no loss, extremely negative sentiment, partly tied to United Health and the sort of the culture's awareness that these companies may have been unethical in the past and need to be fixed. And then an opportunity to buy productive assets at a huge discount. Again, the inverse of the speculator's mindset is like the prices keep going up and it's a green light. I should jump in now. It's going to keep going up. The value investor has the inverse of that way of thinking. They say, well, I have no clue what the price can be tomorrow, but the price is so low and it's below demonstrable appraisal of their intrinsic value that we should be safe, even if we're wrong. Worst case scenario, we'd mitigate our losses if we were wrong substantially because the price is so low already. And in the case of United Health, we've got a decent dividend as well.
Okay. Nike, can you give us an update on Nike? It's another stock that you liked. Let me just pull up this chart here.
I've always liked Nike.
Yeah, it's up like 40% this year since April's lows. But anyway, I'll let you talk about that.
Yeah, I mean, it's a great company. We've followed footwear for a really long time. We had been critics of Skechers in the past, although we've also been long. We've been short Skechers. So when you look at kind of like a Skechers versus a Nike, you can really see the difference between a company that really invests in R&D and produces a better product. Nike's got this really interesting technology they're developing, 3D printed shoes, trying to make a better fit all the time. And
3D printed shoes. Have you ever tried one of those?
No, I haven't.
I haven't either. Wow.
I haven't, but
okay.
There's only so many really truly iconic American brands. You think of like Harley Davidson or McDonald's or something, or Coca-Cola. I mean, Nike's right up there with it, and it's an important product that I think you said last time, David. You keep your shoes for a long time, but most people cycle through them. They have to replace them. I know there's a niche market for collectors, but it's just such an incredible product. Now, I think they got a little bit wayward. Some of their shoes were ugly, and people are like, "Oh man, that thing's ugly." And there's a lot of effort to clone the Hoka model with these gigantic bases of their shoes. I think that's a little bit of a fad, frankly. I'm not sure how much real health benefits that provides, but it's not that hard for these companies to iterate models quickly. So if they make a mistake and they get into doing something wrong that's misguided or it's just ugly, and I agree, some of their shoes are just ugly lately, but they can fix that. It's like a fixable problem. So, when you see it trading, I think at the time, the first time I talked about it, David, back in April, it was trading at like the lowest it's in like 20 years or something. I mean, what else do you want? It's Nike, for crying out loud. You don't have to be a rocket scientist to figure out that that's probably going to be a safe investment at that price. So yeah, I think it dramatically outperformed the S&P 500 as well, like Kohl's and Big Five that we talked about on your show.
Where do you find value right now? Which sectors, which particular subsectors, any stocks that we haven't talked about yet?
Well, it's hard to find right now because the markets are high and there seems to be a lot of euphoria, but there's the healthcare stocks, like we talked about Centene and United Health.
Yeah.
Again, not investing advice, but that's what we're owning. It's just what we're doing. Do your own homework. But I hate saying this because shorting is such a terrible business, but there's value on the short side. Shorting could not be more unpopular. They're like basically almost like criminals in the market, even though time and time again they're doing the best research. The short sellers have all but disappeared. That should be a great indicator that maybe there's more opportunities on the short side. But I hate to promote short selling because it's just a terrible business. It's unlimited risk. I don't want anyone to do it who's listening to your show. But there's things that I think are just great short ideas.
Well, you recently read about Nikola, which is a company involved with the production of EV trucks. They were famously involved in a SPAC a couple of years ago, but I'll let you give us more details about that. Let me just show the piece that you've written real quick before we jump into a video. For over a decade, a unique vantage point has defined the author's work. Our investigation begins with Trevor Milton, the enigmatic founder of Nikola Motors. His story is widely disseminated, a meteoric rise culminating in a staggering $34 billion valuation for a company that went public via a SPAC. When Nikola's house of cards began to fall, Milton, in a dramatic interview with Tucker Carlson, cast himself as the innocent prey of a hit piece orchestrated by short sellers in a shadowy deep state conspiracy. Okay, I'm going to play a video clip for the audience from your channel, but before
Great.
we
Let's get
show
some
that,
popcorn.
just evaluate what you wrote. Is that true? Was he right? Was that an accurate account of, actual events?
Oh yeah, I mean, it was a huge wipeout. There was tens of billions of dollars lost, and shareholder capital was destroyed. Milton himself did pretty well. He got away with about $1 billion. So I think you just have to follow the money trail to figure out where the victims are at. I mean, it should just be simple math, right? Like second grade math. Like, who are the losses? You've got probably a bunch of pension funds and private equity funds and stuff where you got a bunch of people who probably don't even know they're invested in those funds. Many layers of decision makers allocating to these. They're not really IPOs; they're reverse mergers, a SPAC, and it's kind of an old story. There's no real value creation. I think the company at the time of its IPO, its SPAC IPO, had $36,000 in revenue, which was tied to solar panels being installed on Trevor Milton's house, and they achieved a $34 billion valuation. And there was quite a detailed short report put out on the company. I'm not aware of a really comprehensive refutation of those points made in that report, and the company collapsed. Like many SPACs have, they weren't alone. It's just the size of the Nikola wipeout and the damage it's done to shareholders. But I'm sure Trevor Milton's not the only one who walked away with a decent payday. I'm sure there's plenty of investment bankers who did quite well and earned fees at the IPO. And the people who really you never read about that aren't in the headlines, the ones they do very well as well. They make a killing on these things, these IPOs, and then speculators and people who sort of buy into the narrative get hurt because they don't know what the balance sheet shows, that there's no revenues, that they're basically pre-operational, and that there's a lot of hopes and dreams involved, but that's awfully speculative. So he was prosecuted. I think it was 4 or 5 years prosecuted. He was found guilty of securities fraud, and he was ultimately sentenced to 4 years in jail. Never spent a day in jail, I don't think, though. He was ultimately he was absolved by President Trump. He got a presidential pardon. So interesting story. But he's going to be okay. As I say in our podcast, he'll be okay with the remaining $700 million he's got left after legal fees. His investors probably not.
Here's the video clip that you put together.
You trusted the market. You believed in justice.
Nikola shares are tumbling after a short seller called the company, quote, an intricate fraud built on dozens of lies.
Then, the unthinkable. A giant fell. Billions vanished. Trevor Milton, a name whispered, then shouted across Wall Street.
In a lifetime of listening to stories about innocent people wrongly prosecuted, I have never heard anything like what happened to Trevor Milton.
He cried foul. A, quote, hit piece. He called it a deep state conspiracy orchestrated by, quote, evil forces.
So a short seller is a person or a fund that actively bets against you that your stock is going to collapse. So unlike a regular investor that buys shares and they hope that the stock goes up, short sellers buy shares and they force it down. So it's like it should be completely illegal.
What was your reason for pardoning Trevor Milton?
But what if the very architects of the accusation were the true manipulators? What if that, quote, hit piece was a spotlight?
I'm going to leave that here, and people can check out the entire clip. I'll leave that in the clip here. People can check out the entire clip on Father Emmanuel's podcast. I'll link it down below, the video that you can watch. Father Emmanuel, why is your story relevant even today? I mean, what lessons can we draw as investors from this incident?
Yeah, I got to say, I feel that I have a very, well, a sort of special knowledge, if you will, of the situation, because the lawyer who represented Trevor Milton in his defense, and ultimately, in my opinion, was more than likely involved in his presidential pardon, although he denies that. His name is Brad Bondi, and he's the brother of the sitting attorney general. And incidentally, Brad Bondi's the same lawyer that the targets of my short reports hired to defend them, namely Ligand Pharmaceuticals and Viking Therapeutics, two companies that, in my opinion, are complete frauds. That resulted in my unlawful prosecution for 10 years. Milton was prosecuted for 5 years. I was prosecuted for 10 years. He spent $180 million in legal fees, $100 million from Nikola of shareholder capital, $80 million out of his own pocket, presumably from share sales at the IPO, paid to Bondi and his firm, went to trial and lost. And he claims he's a victim. I went to trial and actually won against the US government. So I'm watching this episode on Tucker Carlson. First of all, I completely lost respect for Tucker Carlson because I don't think he's being in any way honest during that show. But I think the whole episode was completely misleading. So I get up one night at like 1 a.m. I'm watching this Tucker Carlson episode about Trevor Milton. And I'm like, this is a bunch of crap, frankly. So, and I know the people involved, this Bondi character, he's a shadow lawyer. I call him sloppy Brad Bondi because he can't do anything right, doesn't really win at trial, as evidenced by the Trevor Milton loss. But he's got all these connections in the deep state. If you think the deep state's just a mythology, it's not. I'm here to tell you it's real. And, it's guys like Brad Bondi that epitomize it. So, you're watching this guy, like all of a sudden his sister becomes attorney general, and like his clients, like Trevor Milton, pretty soon they're getting like presidential pardons, and other clients like Caroline Amnesty are getting charges dropped against them. And you look at the whole thing, you're like, our entire system is corrupt. Our legal system's corrupt. And if our society, if our democracy is not predicated on a healthy and sound legal system, if it's predicated on sort of these consolidation of power amongst these deep state shadow figures that, again, that Brad Bondi, in my opinion, epitomizes, we're in real trouble because the securities market, for example, David, is predicated on sound law, right? I mean, when you buy a stock, you have to make sure that your security interest, like your right entitled to that stock, is protected by sound laws. So if the legal system becomes like a banana republic because of people exploiting it like Brad Bondi, then it's a real problem for all market participants. So we did that episode to just sort of bring it to light, say, look, we know the people involved. Obviously I had a very close connection with Trump myself. I've sat in the room with this guy, Brad Bondi. I know who he is. I know how he operates. I know how he gets things done. He was a former high-ranking official at the SEC, direct ties and friendships to commissioners, former counselor to two commissioners, including Paul Atkins, the current chairman of the SEC. And the strings they pull behind the scenes, we start to get into it in that episode. But if you want to really look in the seedy underbelly of Wall Street and you want to see what short sellers are looking at and what they're doing when they're exposing fraud, in my appraisal, there's no question that Nikola was a fraud. I'm not here to judge Trevor Milton. That's God's job. But other
how did you know? I mean,
yeah.
Let's say somebody knows nothing about the case. He's watching Trevor Milton's testimony on Tucker Carlson, and then he's listening to you. How do they make a judgment for themselves? Right? What should they be looking at?
Well, if you're inclined to, first jump into the accounting right away.
Yeah.
Like I gave the example, a company with $36,000 in revenue. So historically, David, when a company goes public, they usually have a track record of revenues or revenue growth, and they need to access public markets for capital to continue to grow. What is a SPAC? It's a company that's like you're investing in a SPAC. You don't even know what they're going to acquire or what they're going to merge with. And when the investors find out, it could be nothing but a bunch of smoke and mirrors, which is what Nikola was. In this case, the one that really kind of made headlines is that Trevor Milton, we talked about this in the episode, says that they had this functional hydrogen fuel cell truck, but it really wasn't functional. They did a commercial and everything. It was just rolling downhill. It gave the investors the impression that it was fully functional. But there are many allegations against the company. You can find them in the short seller report by a company called Hindenburg Research. Nate Anderson was the author. I think he did great work, as most of the short sellers do. And you could read that report if you're inclined to, but you could also just look again at the math and say, where is the 34 billion? Where did it go? If there was real technology or IP, and Milton, by the way, had a history of other failed endeavors prior to that. But listening to him in the interview, and if you're not even slightly financially sophisticated, you might believe what he's saying. But anyone who has a modicum of experience in Wall Street realizes that nothing he's saying is adding up. And Tucker Carlson, again, is sort of giving him this exculpatory platform to cleanse himself, if you will, of his sins, in my opinion, where he's able to go on the show and write his own narrative, and nothing's really seriously challenged, and Tucker Carlson's acting surprised, and it's really, really political. Tucker Carlson's a political commentator, really. He may come off as an investigative journalist, but he's really not. And I think that that's so destructive to markets, because if we create narratives that have nothing to do with the truth, you could mislead so many investors and not getting them to actually think critically. And I would say start with the financial statements, read the reports, listen to what they're saying carefully. You have to do that as an investor. You can't buy narratives and stories, because we're really living in a post-truth era where the truth is relative. Everyone thinks it's what they make of it or what they say on a podcast. But there is something as real as a transcendent truth, a real truth, and that's really what we're trying to get to.
Well, here's what I think. Even if you haven't done the due diligence on looking into the financials yourself, you just look at the price chart here that I have on the screen, and you can see that short sellers drove the stock to basically zero. It's now a penny stock. But if you were to believe that markets are, if you were to believe that markets are a discounting mechanism, in other words, the collective group of people involved in the markets use all available information to make a decision and then execute on that decision, you would think that the markets are fair in that sense. In other words, if it is indeed true that what Trevor Milton was saying is accurate and then he was being wrongly accused of all these things and people were unfairly shorting him, well, smart investors would have picked up on this and then bought the stock back. But that's not what's happening now, right?
Yeah, you're exactly right. Yeah, you're right. I mean, what you're referring to, David, is efficient market theory, EMT. And it's, in the long run, it's true. The market generally gets things right. Enough people figure it out. It's in the short run, you find these big price value dislocations like Kohl's or Big Five or whatever. In the long run, the market generally gets it about right. But how could it be that, 34 billion in value, and what's left? Where's the technology, the transformative technology? Where's all the things he was going to do? And I don't want to get into all the weeds on it, but they were extraordinary claims. And so again, it's an old story of the guy who goes to Wall Street, sells oceanfront property in Arizona, and people buy it without doing any real due diligence. And then the question is, where does the money end up in the end? And there's a lot of people who were harmed by that SPAC. Not only that SPAC, we shorted a lot of SPACs during that time, by the way. And, but he's not. He's going to be just fine with the remaining 700 million, as I always say. But most investors in Nikola can't say that. So it's a well-trained, like a good leader, a good CEO, a great business visionary creates long-term value, right? There'll be ups and downs, of course, but great companies create value for their shareholders, who are the real owners of the companies. When there's a corporate governance problem and it becomes a smash and grab operation, which is what a lot of SPACs were, that's a disregard for stewardship of other people's capital. And when Wall Street is dysfunctional, it becomes a wealth transfer operation for that. And again, you don't see the investment banks, the role they play, or the lawyers, the role they play behind the scenes. Guys like Brad Bondi were very well compensated. And, just going on a tangent for a second here, he was protecting Ligand Pharmaceuticals that we had criticized publicly. He lied a great deal in order to do that. But in my opinion, this was a company that was killing for profit. Forget hydrogen cell trucks. The pharmaceutical industry, they'll kill for profit. And there's lawyers that will defend that because there's a money trail. So you don't have to be like a great financial analyst. You don't have to go to Harvard and get an MBA. You don't have to be an expert securities analyst. You just got to ask really basic common sense questions, which are, who was enriched and who was hurt? Where's the enduring value? Look, Henry Ford, he created enduring value, right? Sam Walton created enduring value. Steve Jobs created enduring value. Warren Buffett, same thing. Yeah. I mean, these are like smash and grab jobs that, it was like a mania during the pandemic. There were a lot of SPACs. Most of them are gone. But you have to sort of be able to recognize just how bad Wall Street is and how there's a network of people making that. And those people get enriched while everyone else gets hurt. And in my opinion, that's what Nikola was. It's not even an opinion. I mean, it's verifiable. Huge amount of shareholder value destroyed, 34 billion. And the guys, and it's not just Trevor Milton. There's a lot of investment bankers who did very, very well, I'm sure, on that spec.
So walk us through an average investor's decision-making process to avoid getting hurt in a similar trap going forward. This is not the last SPAC. This is not the last IPO. Yeah. This is, there's going to be more of these, right? How do we spot them?
Yeah, some basic rules, David. I'd say make a checklist for yourself. Just avoid IPOs. Why do it? I mean, you can find price value dislocation comes with 20 years of history. Why do an unknown? That's like going on a blind date. Like, what if the girl is ugly? Like, you don't want to go on a blind date. Like, find a girl that is beautiful. Go on a date. Like, find a balance sheet with the 20-year history that looks beautiful and consistent. People succeed by saying
because
no
there's more upside
often.
Potential. That's the logic, right?
Well, you know what you're buying. You're kind of guessing at what you're buying with an IPO. You're like hoping it's going to work, right? But if you can look at 20 years of financial performance, you know what you've got. right? So I would say avoid
Mm.
IPOs. I would say definitely avoid financial innovation. Not all but financial innovation is bad, but like why get into innovative things that you don't really understand, and avoid things you don't understand. There's an analogy out there that, investing is not like diving in the Olympics. You don't get extra points for, it being complex or complicated. You can just focus on really simple things you understand. And successful people say no often, but really successful people say no almost all the time. So your success might very well be predicated on all the things you say no to. And that's okay. You don't have to swing at every pitch. Like right now, the markets are very expensive. You don't have to, if is money burning a hole in your pocket? Like if it is, that's a problem. Maybe you just sit on the side and say, I don't have any really great ideas. Like I'll just sit on my cash. That's totally defensible. You don't have to have ideas all the time. Every day you wake up and you got to trade something. The saying that, as activity goes up, returns go down is very, very true. So if you find that every day you wake up, you've got to trade something, you're going to beat the market, like chances are the results are not going to be that good. So I would say just set some boundaries, keep it simple, things you understand, long track records, and then all these like list of no's. You're going down your checklist, and maybe you got like 5 or 10 things on there. You're probably going to sleep better at night, and you're probably going to get better than average returns with really simple common sense stuff. So, if you're reading financial statements or a press release from a company and you don't really understand what they're saying, they're talking about like adjusted non-GAAP EPS or something. There's even crazier terms out there. Like, I don't really know what they're talking about. Guess what? It's not because you're dumb. It's not because you didn't go to Harvard and get an MBA. It's because they don't want you to know what they're talking about. A great CEO can explain his company in very simple terms that are understandable and should. So like whether you're talking to your financial advisor or you're listening to a conference call, the second you feel bewildered or confused or things about, a lot of investors, they're human, right? Like we're all human. So you got pride, you got a little bit of ego, and you're like, maybe I don't understand that. I'm not as smart as I thought, but I'm not going to say anything. You start thinking that way, they got you. There's no such thing as a dumb question. Ask questions. You can get on these conference calls. You can ask questions to the management team. Do it sometime. Ask questions. Look, explain this to me. If your financial advisor is explaining all this stuff and you're like, you don't really know, don't feel stupid. Like ask basic questions. If they can't give you basic answers, move on. There's no shortage of companies out there. Tomorrow's going to be another day, by the way. Every day the market produces something new and unexpected. So as the saying goes, patience is a virtue. It's certainly true with capital allocation.
So we got a few minutes left. Let's close on this. We've got a couple months left before the end of the year. The last quarter is coming soon. What should investors be watching for? Events, news, deadlines that can move markets?
Yeah, well, I think we should all be very concerned about the geopolitical turmoil. Let's pray for a positive outcome between this emerging conflict between Russia and NATO and the United States. Obviously, probably the bigger conflict is the emerging conflict between China and the United States. Nobody really knows for sure what that will mean for capital markets. Maybe it's a sad commentary, but typically, or at least historically, wars have been stimulative to the economy, but we should never pray for war. We should pray for peace in the world. War is a horrible thing, and we see wars breaking out all over the world right now. And, I don't know that Americans, this current generation, has thought about what the world would look like if it's a China-centric world, which it seems to be heading towards. And maybe what we witness right now in the West, and the United States in particular, is sort of the fits and screams of an empire on the decline. I don't like that at all. I'm American. I grew up mostly in America. But what will that mean for capital markets? And if the conflict between the US and China, for example, if China were to invade Taiwan, what would that mean for capital markets? So there's all these really big issues that no one's really lived through before. It does very much so look like a piecemeal start to World War III. If you're going to buy anything, just know what it is. Make sure it's stable. Like we talked about Flour Foods last time on your show, David. They make Wonder Bread and Dave's Killer Bread and all those things. That actually beat the S&P 500 as well since our last show. It could not be more boring. But even if World War III breaks out or continues to break out, whatever you think about World War III, like people are going to buy milk and eggs and bread. I talked about in the last show. Companies paying a dividend, providing a product you understand. Don't take wild risks at a market when the market's so expensive and there's so many unknowns in the world right now. There's tremendous suffering in Ukraine right now. There's tremendous suffering in Palestine, in Gaza, in Israel, in Iran. There's all these conflicts. We don't really know where it's going to go. I would just say be all the more reason to be very cautious. Some of the greatest investment thinkers in history, like Benjamin Graham, for example, the mentor to Warren Buffett, he was a product of the Great Depression. He lived through the 1929 crash, where stocks collapsed, the index collapsed up to 90%. that made Ben Graham who he was. The idea of if I could buy a dollar bill for 50 cents, I'll be safe. He was the product, and he was forged in great tumult. So don't, everyone looks a little smarter during good times like we're in now, like including myself. It's easy to look a little smarter when everything's going up, but it's going to be those trying times, which will happen in the future, that people will get a little bit of a clearer sense of what it means to understand the actual security underlying your investment, whether it's equity or bonds, whatever it may be, real estate. You've got to understand it, and you got to be comfortable with it and say to yourself, what if this wasn't traded on the market every day? What if I couldn't see a price every millisecond? Would I be comfortable owning this even if the stock market was closed for a week or a month or 3 months, which has happened historically, by the way? Would you be comfortable owning it and sleeping at night, knowing what the company was, how it produced its revenues, how it treated its shareholders, what the culture of the management team was like? If you do that, I really think you'll sleep better at night. You'll feel comfortable. The geopolitical stuff won't mean as much, but invest like the worst is yet to come, because sooner or later, there are going to be some very, very bad things happening. That's the story of history, and you should always be investing in that way.
Okay, excellent. Thank you very much, Father Emmanuel. I know you have to get going, so I'll let you go here. Where can we follow you and learn more from you?
Yeah, absolutely, David. Of course, there's lemelsoncapital.com, our website. There's amvona.com, where if you do want to read more about our very public fight with the U.S. government, and earlier this year, the former Vice President Michael Pence joined our legal team and his legal group, as well as 27 other organizations, in a fight to get back our legal fees from the U.S. government and my unlawful prosecution. But probably the best place to follow us is our podcast, which you can find across all of social media. But it's a very visual podcast, so maybe YouTube is the best place to watch it, though we don't have a really big following on YouTube yet. But if you go to just @Lemelson on X or YouTube or Facebook, LinkedIn, you'll find us, Rumble, you'll find us in all those places. And we'll hope you'll take a chance to take a moment to watch these podcasts, especially that episode 44 you played a clip from, talks a little bit about some issues that I think your followers might find very, very interesting, and understanding, again, sort of the seedy underbelly of Wall Street. It's always there. It's always been there. So being aware of it, I think, is incredibly important. But I'm really grateful for the invitation again, David. I absolutely love your show. Best show out there. And I hope we can do it again.
Appreciate it. Thank you very much. Well, definitely a lot of volatility to come, and we'll follow up on some of your picks from today. They've been extraordinary since the beginning of the year, since you've been on. So congratulations so far on a very good year on your picks. So we'll follow up. Thank you very much.
Thank you so much.
We'll put the links down below. Yeah, follow Father Emmanuel there, and we'll speak next time. Don't forget to like and subscribe.